rolling.
Okay, our next focus is on managing risk in terms of saving, investing, and risk management. One way to minimize risk is to buy insurance. In some cases, you have to buy insurance legally in the state of Virginia and other states. In other cases, it's optional. When you do choose an insurance, it's important to know that it's a legal contract between the company and you, the insurer. Why do people have insurance? Well, it's to protect people from unforeseen health expenses or loss of income. So this could relate to health insurance or loss of income if someone gets in a car accident. People have insurance for money and housing if a home is damaged or destroyed by fire. Usually, when an older sibling or your parents, when they do have insurance, they have to pay something called a premium. Okay? A premium is the amount paid for an insurance policy. It can range from anywhere from maybe $200 for well, let's say it could range from anywhere from $50 to maybe $300 a month. And then if something happens, a policyholder makes a claim. So let's say you hit into a tree by accident, backing up. In that case, you can make a claim to your company, and most likely before they fix the damage, let's say it costs $2,000, you have to pay something called a deductible or a co-payment. In this case, it's the money paid out of pocket before insurance covers the remaining cost. So, if your bumper in the back is hurt or is broken and needs to be fixed, if it costs $2,000, the insurance company may say you have to pay the first $500, and that would be your deductible. It's the same thing when you go visit the doctor. A doctor visit may cost $300. You may have to pay $50 up front as a co-pay. Another important term is risk. Again, people have insurance because of the possibility of financial loss. Now we're going to look at some examples of insurance. Okay, these are the most common. If you own a home, you have homeowner's insurance that protects your home and garage. If you are renting, it's optional in some cases, but you can get renter's insurance. Another different concept is medical health insurance, which is a requirement under Obamacare. Another concept is auto insurance, which protects you against different things like collision coverage. It could protect you if your car breaks down and you need to be towed. Another example of insurance that you may have is phone insurance. This is if it gets lost or stolen or damaged. You may have to pay a small deductible and you get a new phone. If you live in California or other places where floods or earthquakes are more prevalent, in some cases you need to get earthquake insurance in California, where a homeowner with no place to live because of an earthquake. So, because earthquakes are more prevalent there, you may need to get insurance against earthquakes or floods or hurricanes, things like that. And then another insurance is dental insurance to cover basic preventative cleaning and also helps to cover things like braces and any other dental needs. Those are the most common insurance types. All right, the next term we're going to look at is something called compound interest, which some of you have learned in your math classes. Compound interest is a very basic concept where interest is paid on a starting amount, which is called the principal plus prior interest. Okay. The key idea with it is with compound interest, you earn interest on the interest that your savings earns, which over time can grow. So we're going to look at an example here. Christy invested 5% starting at age 25. Now if she does that, it compounds. So her interest is growing. The interest is earned on the interest that her savings earns. Therefore, at age 45, she will have $26,532 from $10,000. Now that's saying that you're getting an annual 5% interest rate. However, Josh starts 10 years later at 35 and only makes $16,000. So that demonstrates the importance of compound interest. Last part of the lesson today is that we're going to look at how to write a check. Okay? Checks are very important. They're a way to pay. Often it's used, with companies. Companies, for example, or even babysitting, you may get a check. That's when it's in place of cash, and it's people not using a credit card. The check, again, comes from a checking account. All right, so some tips for checking accounts. Know your account balance. You don't want to spend more than you have. If you do, it's going to be called bouncing a check, which will mean that it will be either your bank will overdraft, meaning it will compensate for it, or the check won't be accepted, and you could receive fees on it. So it's important to constantly monitor, have online or mobile banking to monitor your checking account. All right, so we're going to quickly go through how to write a check. Follow along as I do. Use a pen when writing a check, to preferably black or blue, which is professional. In the upper left-hand corner, usually the check will already have your name, address, and zip code. You're going to write down the date. You're going to write paid to the order of, who it's going to be paid for. The dollar amount is going to be $25, as number 5 says. And then you're going to write a fraction, 25, and then across 0 and 100. You're going to write the memo, what it's for, and then sign the check. So here is an example of the finished product. As you can see, I'm excited about summer, so I'm going to King's Dominion. I wrote a check for 25. You write out the words, and then you put an arrow and put 0 over 100. Now if it was $25.64, I'd put 64 over 100. Memo tells you what it's for, and then you need to sign it. To accept a check, all you do is you flip to the back, and you sign at the top, and that's a verification that that's the person who gets it. So in this case, it would be King's Dominion, but often it's a person's name, like Mr. Buck.